Thank you for joining me again today. Today we're going to be covering Chapter 9 of my book, Managing Your Investments. The title of my book, as you know, is Financial Independence, Getting to Point X. This chapter is so important that I broke it up into 3 separate chapters. Before I jump into the details here, just take a minute or two and read this famous quote from Warren Buffett. Okay, so in this chapter, we have a question, and that question is, do you understand the difference between the different investment choices? Do you know what stocks are, bonds are, mutual funds, ETF, the various real estate investments that are available to you? So when I meet with a client for the first time, what I do is I have to determine what the most appropriate investment model is for them. And again, it's not one size fits all here. It's a very individual process. So the first thing I have to do is analyze your financial ability to take risk. And how do we do that? Well, quite frankly, we cover that in Chapter 3 of the book, which is determining your financial net worth. So I'll put together a personal statement of net worth, list out all your assets, your liabilities, look at what your financial net worth is, because that is sort of like taking an x-ray of what you look like financially, how healthy or unhealthy you are. Once we have that picture, then we can make good investment decisions. What's the best use of your money? Should you be paying off some credit card debt or other loans before you start investing? Those are the type of things we need to address before we determine not only how you should invest and whether or not you're even ready to invest at this point in your life. On page 253 in my book, I have 6 questions that will help us measure your psychological profile when it comes to investing, because we want to make sure when you're on that roller coaster that you're on a roller coaster that you're not going to jump off of because it's too much of a fright for you because of the huge ups and downs. So we may find one somewhere in between, or maybe we'll find something that is more of a kiddie ride, but whatever it takes to keep you invested, that's really the purpose of this questionnaire. So I'd encourage each of you to turn to that page of the book to assess your own financial willingness to take risk. The other important thing here when it comes to investing is understanding what those risks are. So, for example, inflation risk is a big deal, especially today with out-of-control inflation. Right now, the inflation rate is north of 8%. Hopefully, the Federal Reserve will get the inflation rate down without bringing us into a full blown-out recession. You also have to understand interest rate risk. Interest rate risk has to do with bonds primarily. So right now, the Federal Reserve is actively raising interest rates. When interest rates are increased, the value of midterm and long-term bonds, they go down. Beginning of 2022, we had a bond market crash because the Federal Reserve said inflation's out of control. We need to raise interest rates rapidly, and that's exactly what they've been doing throughout all of 2022, and I think that may continue easily into the first quarter of 2023. So the point of the story there is understanding interest rate risk and putting yourself into shorter duration bonds or other bonds that do not have high interest rate risk is critically important at this point in time. The other risks we have to concern ourselves is general market risk, economic risk, and then there's company-specific risk. These are all discussed in great detail in my book, so I encourage you to read through that. So what are the basic general investment choices out there? There are stocks. Stocks basically mean you own an ownership interest in a company. You need to know about the various type of bonds and what is most appropriate not only for you as an investor to invest in, but also based on what's going on in the economy. There's hybrid securities out there as well, which is a combination of both. A good example might be a preferred stock or preferred stock ETF. You need to understand about mutual funds and how those work, the advantages and disadvantages of mutual funds. Exchange-traded funds have become very popular over the last 10 years. I'm a big believer in exchange-traded funds because they are highly tax efficient. So part of my tax smart investment strategy, we put a good amount of weight into exchange-traded funds for that reason. Real estate, As you know, there's a long list of real estate asset classes out there, everything from student housing, self-storage facilities, multifamily homes, understanding the different type of real estate asset classes. One of my other presentations, I'm going to talk quite a bit about real estate and some alternative real estate investments with you. And speaking of alternatives, there's also what we call alternative investments. The other important thing when it comes to investing is these three tools when it comes to managing your financing. The first one is diversification. Now, I'm a firm believer you shouldn't have a little bit of everything in your portfolio. A lot of standard models just give you a little bit of everything. I hate to be direct about this, but if you have a little bit of everything, it may mean you have a little bit of some things that you shouldn't have at all, right? And speaking of asset allocation, it's not just about allocating your assets in a model, but you need to take advantage of asset allocation by location. Can't emphasize how important that is. So, for example, certain assets give you preferential tax treatment. So capital gains get taxed at a lower rate. Qualified dividends get taxed at a lower rate. So typically you want to keep those type of assets that are in your portfolio in your individual investment account. The other strategy we implement is periodic rebalancing. What that forces you to do with your investing is one asset class extremely outperforms, and now your model is out of whack because you're overweight in one item and underweight in something that underperformed. This gives you an ability to cash out on some of your earnings and now use that money and buy into something that's selling at a lower price. So rebalancing is also another important part of the overall investment process, and a skilled financial advisor should be taking advantage of these strategies for you. So up on the screen, and this comes out of my book, although it's been updated through 2021, but I'm showing you a list of a number of different asset classes. One of the mistakes that many investors make is they'll look at a prospectus or they'll look at a mutual fund list. They'll go down the line and say, okay, which mutual fund did the best last year? And they're going to base their investment decision on what did the best last year. The only problem with that is no way to invest, because very often what was the best performer last year could easily be the worst performer in the current year. So I call that, following the leader. And if you follow the leader, chances are you're going to end up a loser. So make sure when you pick your investment choices, don't necessarily do it based on what performed the best last year. You got to look at the overall economic situation and make your decisions from there. So this chart here will show you, for example, REITs have done extraordinarily well over the last 10 years. So the average return during this 10-year period has been about 14%. In their best year, they earned over 41%. In their worst year, they lost about 5%. But overall, it's been a very good asset class. So I'm not going to go through each of these with you, but the simple point I'm making is that each real estate asset class comes with a certain degree of risk. So understand what those risks are. We need to pick them wisely, and definitely do not follow the leader and put all your eggs in one basket based on what did better last year over the last 5 years, because that could be the big loser over the next 5 years. So the next slide here is what are the big drains on your investment return. Number one, inflation. I already covered that. Number two is taxes. These are the two biggest enemies to your investment return, because if you're not beating inflation after taxes, as I mentioned earlier, you're really losing money. So inflation, unfortunately, we have very little control over as individuals. That's really up to the Federal Reserve to control that. But taxes, that we have significant ways of reducing it. So tax smart investment strategies. Number one, you must implement a tax smart investment strategy. Number two, this will ensure that you maximize your after-tax rate of return on your investments. This will create tax alpha, which will increase your after-tax rate of return without taking any additional risk. Now let's think about that for a minute. Every investment advisor, their goal is to create tax alpha. And what is meant by tax alpha? That basically means making a rate of return higher than what other investors would make given a certain level of risk. That is not easy to accomplish, but the very best of investment advisors manage to achieve that. So, in summary, we have a financial action plan when it comes to managing your investments. Again, I have a series of 3 presentations on this subject, so we'll be sure to cover all these when we get through all 3 of these programs. One is know your tolerance to risk and properly determine your ability and willingness to take risk. Understand the different types of risk that affect your investment portfolio. Diversify your investments so that you do not have all your eggs in one basket. Remember, don't follow the leader of last year. Number 2, do not try to predict when the best time to invest is. Instead, invest your money regularly and throughout the whole year. Know the tax and inflation implications on your return and try to maximize your return in after-tax dollars. Implement these tax-smart investment strategies to increase your after-tax rate of return without taking one iota of additional risk. That, to me, is the most tax-smart thing any investor could do. If you're not paying attention to taxes when it comes to your investments, you're making a big mistake. Don't make taxes dictate what your investments are going to be, but it should definitely be an important part of the decision-making process throughout the investment process.